Hello, everybody. Kirk Spano here. Stocks of the week and retirement income options. Pre-show, we were listening to an interview that I did with Forex Analytics this morning. And I encourage you to go to the Forex Analytics website on YouTube, their channel, and go ahead and listen to this because, we ended up being kind of funny, but we covered a lot of ground and brought some understanding to what's going on with the oil market and its impact on the economy. Now, as most of you should know by now, OPEC decided to keep their oil cuts in place through the end of the year. These are not brand new oil cuts, really. These are a follow-through on commitments that were already made. There's over 1 million barrels of oil per day that are going to stay off the markets. And I think that most people are misreading what this really is. So we're getting a price surge in oil, but it really means that as the summer demand goes up, there's going to be a deficit of oil on the supply side. So you're going to see up to 2 million barrels per day of oil coming out of inventory over the next 6 to 12 months. That's not a massive amount in the long term. However, we have to keep in mind what we know about the energy transition and what we know about the frackers in the United States. I showed a chart, which I might still have up. I did. The United States lost 200 oil and gas companies between 2015 and 2020 and really 2021. And it happened because of two reasons. First, OPEC flooded the market with oil at the end of 2014 and 2015, driving the price of oil down, which destroyed the frackers because they weren't profitable until oil was in the 60s or 70s at the time. Now they can make money in the 40s. So the frackers that are producing right now are making money, but it's at a decreasing rate because they've high-graded their fields. What does that mean? That means that they've already pumped the easiest and cheapest to get to oil, so the oil they're getting to now is more expensive. By next year sometime, probably by the end of next year, the oil is so tough to get in most of the fracking formations, with the exception of the Permian, that you're going to see a drop-off in production in the United States, I'd say in 2025 or 6, which happens to coincide with more and more vehicles being EV anyway. So we're going through a transition. It's going to be lumpy. It's going to be choppy. Saudi Arabia is trying to keep the price of oil up as high as they can while there's no alternative to oil. As cars go EV, that's an alternative. 1 in 11 cars sold in the United States are already EVs. It's a higher number in Europe and in Japan and even in China. So you're already seeing EVs all over the world. And by 2026, it's probably going to be close to half of all the cars in the world are being sold are EVs. And by the end of the decade, it'll be around 80%. We know all these things are coming, but there is a few years here between now and 2026-ish that the price of oil can be kept high until more oil supply comes on from other nations. The panic pumping that I've talked about, it's already starting to come in Africa, and most countries are going to disassociate themselves with OPEC at some point. I think Venezuela is already on the way out. You're probably going to see Algeria on the way out. You're not going to see countries beholden to OPEC anymore, even if they're members right now, because they have to look out after number one. So next 2 or 3 years, what does that look like for investing in American oil companies? It has to be Permian companies, and it has to be companies that have a transition plan. And we've talked about our companies. We own Permian Resources. Ovintiv just went out and bought a ton of Permian acreage. The Permian acreage that Permian Resources have is very profitable because they bought it very cheap. They bought it out of these bankruptcies here. So when you look at this as an investor, it's a little different than when you look at it as a macro person. But the macro person can tell you what I'm telling you now, which is, hey, energy transition, limited opportunities in oil, but the opportunities in oil are very good, right? So not a lot of opportunities, but the ones that there are good ones. So Permian Resources it's either going to just keep on pumping out big profits and increasing their dividend and buying back shares, or as Ovintiv showed today with a $4 billion purchase in the Permian, they'll just get bought out. Now, think that through. Ovintiv is the old Encana, which I told you was a great company 5, 6, 7 years ago. And because of the flood of oil here that drove the price of oil down, they went through some hardships. But if you take a look at their chart, all of a sudden, boy, are they exciting. So we go take a look at Ovintiv, which I don't want to own because it's not the one that's going to get acquired, I don't think. But you take a look at this and you go, look at this. Ovintiv, right, fell off this cliff, and we were buying it in here especially, and we were buying it over here on this side too. So we bought Ovintiv in here, and it just crashed into oblivion. Look at it now. This is an argument for sometimes you just don't let the volatility shake you out, which I think is a pretty important story and a pretty important thing to understand if you're a small cap investor. Take a look at this. This stock dropped from 60, and I think this is split adjusted even, because I think they did a reverse split in here somewhere. Look at this. Fell all the way down to nothing and all the way back just about to where it was. And it bounced off, and now they're buying $4 billion asset in the Permian. Is it going to chop around and go back up? Probably. But look at this. Another valley of despair and a big comeback. So when I see a few people in the chat room, I think this stock's going to go down from $3 to $1 or $10 to $3 or, look, if you are letting your emotions make you think that because something went down, you shouldn't own it, then you're not going to make money in the long run because you're not a great trader. So stop getting breathy like a trader. Stop trying to tell trader narratives and understand that this happens. And it's going to happen with a lot of those small caps. Because once the Federal Reserve decides that they're tight enough and financial conditions start to loosen, which Tom Lee over at Fundstrat keeps talking about, I just think he's been early, you're going to see a lot of charts go like this, particularly the small caps that are moving towards profitability. You saw it happen in the oil. You're going to see the same chart in the small caps coming. With that, we're going to talk about dividend stocks today because I did publish the plug and play dividend stocks a couple days ago, plug and play growth stocks today. I'm going to update some charts, but the plug and play dividend stocks I think are important for you, and you're going to want to know about where these are going to go if we get the type of correction that I've talked about, or if there's something worse, which is what Jeremy Grantham and Nouriel Roubini talked about. So every quarter, Shooter is updating the long-range charts. Well, I just talked about Apple over there with Forex Analytics, and Apple is the one that you need to follow because Apple is the mirror image of the S&P 500, just a greater refraction. And if Apple goes up, the S&P 500 pretty much goes up. Apple goes down, it gets choppy. The S&P 500 goes down, it gets choppy. If people stop buying Apple, S&P 500 has to take a digger. Why? Because it's a big component, so it'll just reflect there. But it also is indicative of less money, less liquidity in the market. I think Apple's about to turn over. The last setup for Apple was at $143. It's up to $162. I think that we'd expect the Apple to retrace at least to 143. The stop here is at 157. So it's a very tight stop to the current price. So if it breaks through 157, probably goes to 143. And I would argue that this trend line infers that we can see a price approaching 100 on Apple. I had thought it could get as low as 80. That would be your Jeremy Grantham, Nouriel Roubini, Armageddon zombie apocalypse zone. It could happen, but the problem is that if we get a spike in energy inflation and the Fed stays tight, then that stagflationary recession that I talked about a year ago, I'd have to look up the article, but about a year ago, maybe 5 quarters ago, could happen. So that's your boogeyman. Your boogeyman is, do we have a stagflationary recession? And I think that the energy transition is moving just fast enough to avoid that. And I also think that, and I mentioned this in the Forex Analytics interview, I also think that the Fed does back off by Labor Day-ish. It's starting to look like they'll for sure do a quarter point in May, but who knows? That is 6 weeks away, 5 weeks away. We had some bad manufacturing numbers come out today. Industry is slowing down. The banking system is tightening up. I don't think the Fed needs to raise interest rates anymore myself. I'm not positive they needed to do the last one, but of course they didn't know that OPEC was going to do this with oil, or maybe they did. So they're going to try to keep the dollar from plunging. So we've gotten the correction in the dollar already, right? So if you take a look at just the last year, stretch this out, the dollar has already been coming off its top. Pretty big decline. So I've said that the new millennial dollar is right around 100. 10 points in either direction. And remember, that is in the context of a bull market in the dollar that has gone on for the better part of a decade. I just don't think, with all the rhetoric about the collapsing dollar, does that look like a collapsing dollar to you? I don't think that it does. So the new floor on the dollar is probably middle to upper 80s against the basket of other currencies. I think it's going to be close to par. And when the dollar approaches this level up here, things start to break. And what happens? We saw the dollar approach that, and things broke. So if the dollar spikes, probably inflation comes down, they bail out the banking system, and then we get a bull market. There's a lot of room for policy error here, and a lot of room for unintended consequences with energy. That said, it should be clear to you by now, and I've been talking about this for a long time. Russia, OPEC, China, they are deliberately trying to cause inflation here in the United States. They are deliberately trying to break things. They are deliberately trying to influence our elections so that we move towards people who talk isolationist and allow them to get away with whatever they want to get away with. If the United States votes in an isolationist, or somebody who essentially allows Russia to do what Russia wants to do, or China, that is very bad for the world. It's very bad for our economy long term, and probably subjects millions and millions of people around the globe to very, very poor outcomes, very bad things. So we'll see what happens between now and the next election, because really what's going on in energy is all about that. And the Federal Reserve is trying to deal with it the best they can. It is good that we put all that money into the economy in 2020, because if we hadn't created that liquidity and that cushion of cash to help try to smooth this transition, because we know that transitions are rocky and scary, and people hate it because bad things can happen. But usually, at the worst moment in any of these crises, you have a wonderful buying opportunity. I don't know if that wonderful buying opportunity is 3,500, 3,000, or 2,500, or 2,000 on the S&P 500. That's why you scale in slowly and wide apart. Here's some of the stocks to buy. Ford. If you get Ford near 10, you should eat as much of it as you can. Intel, we were buying it, and it's now rallied. It's very close to our cost basis now in the low 30s. Now, it's probably going to bounce around in an Armageddon zombie apocalypse scenario. It can get into the 20s. But I think with the cut in the dividend, that probably marked a bottom in the middle 20s. So any dips on Intel, one way or the other, you ought to be buying it. Because Intel, as one of the backbones of the semiconductor supply chain moving to America, the fact that the government just gives them money, right? You follow the money. Intel's going to be a huge winner. And the fact that they spun off Mobileye partially is very good for them. They'll eventually sell the whole thing, I think, but not until the price of Mobileye goes up quite a bit. So Mobileye would be an ancillary stock that you could trade if you wanted to. Paramount. Everybody's been talking about Apple buying Disney. The problem with that is, A, I don't know that regulators would allow it, but B, how do you do that integration? And why would you buy Disney when you can buy Paramount? And we know that somebody made a run at Paramount recently. I don't know who it was, but somebody was inquiring. That news has been out there. Paramount probably has 2 to 3 times upside in the next several years, and they pay a fat dividend right now. Can it get down to 20 again? For sure, because it's almost there. And can it get into the teens? Sure. But it looks like this would be a triple bottom, which is a very powerful buy signal. I don't know that it gets a lower low. I don't think it'll get a lower low, but if you can buy it a couple bucks down, there you go. And this is a fantastic one to sell cash secured puts on because you're close to what the ultimate buy price would be. You're near bottom fishing, and it's a pretty decent premium. AT&T is a fantastic retirement stock again. Big fat dividend, very limited downside because it's got irreplaceable assets. And by the way, we found out the other day that their satellite partner is going to be up and running, only about a 1 quarter delay, which we've talked about all along with AST Space Mobile, is that we know the technology at this point works. It's just a matter of tweaking it and getting the satellites up in the air, which looks like it was going to be delayed by about a quarter. I think that we had all accounted for that. We knew that something like that would probably happen. There you go. So you have this opportunity to buy AT&T because once they have the ability to have their 5G all over the planet, they're going to add millions and millions and millions of global customers. And by the way, they're already forecasting buying back shares in 2 or 3 years, which lightens their burden for paying dividends because there's less shares to pay the dividends on. And they don't have any really major debt repayments for quite a while. They did a lot of restructuring during COVID and really pushed their debt out a long time. Fifth Third Bancorp we've talked about. This is probably the strongest of the regionals. I think it'll become a national at some point. I don't know that it's bottomed out yet. Shooter is looking at low 20s. New Fortress Energy. The natural gas is going to become just more and more important, right? If there's not going to be an increase in associated natural gas from pumping oil. So their liquefied natural gas becomes even more important. Look at that. 1, 2, 3. I mean, this is, I think, going to get off to the races here. And I think it'll set a new all-time high, maybe a lot faster than people think. Shooter's chart, I mean, he's showing a price up over 100 in just a couple of years. Permian Resources, there you go. I can't not like that chart, right? Jumped up $1 today. Any pullbacks or buys? Another great one because of the volatility for selling puts because the premiums are very high. Now, I think the Blackstone and KKR are very interesting. Why do I think they're interesting? Not because I want to buy them right here, but because of where they go in a recession. In a recession, private equity gets clobbered. So if we can get a 2020 price on Blackstone or a 2020 price on KKR, I mean, holy cow. These are both stocks that are heavy into the legacy conventional oil and gas assets, but they're also among the biggest investors in alternative energy. And they're big predatory vulture hunters of commercial real estate and residential real estate. I don't think we're close on price yet. Just keep an eye on these because if these have a waterfall bottom for us, right, they just fall off a cliff. These could be among the best buys of your lifetime. Innovative industrial properties. It's looked like it's breaking down to where I was hoping it would break down to. If it gets into the 50s, you should be token up on this one. So this is one that you can buy in the 50s, big fat dividend, growth industry, alternative margin of safety, and that they can grow crops if they want to, right? They can use all those greenhouses to grow other things other than cannabis. Whatever is most profitable, they can grow it. And they have the technology to do almost anything. Staying industrial, I would love to get this one back to the trend line because as supply chains move to America, these guys are in fantastic shape. And during a correction, when they can buy some warehouses and some factories cheap, and then scale, fix them up and scale them back up, they could see another big run in the not too distant future while they're paying that fat dividend. Digital Realty Trust, I didn't like it up here, but I started talking about it in here. And if we get one more leg down, then I think you start screaming to buy this one. This one in the 70s, or maybe even the 60s, is a fantastic buy, big fat dividend, some growth. And I think that the pause in growth in the data centers is about to be over as soon as liquidity loosens up and the economy grows again. So take these last legs down, right? And don't get all jumpy about what you should buy today. The answer is probably nothing. But if we get these last declines, which would be indicative of a bottom, but also historically logical and consistent, you can make a lot of money. So I've told you to sell some cover calls in the last several months. I don't know that there's much left to do anymore. You should be trimming things that are a little profitable or around where you bought them. If it's an overweight, right? If you have too much of something and you're about even, at least on part of the position, right? Because you should have scaled in slowly. If you have one part of the position that's roughly even, maybe you sell it. I'm still, well over 20% in cash. I don't know if all of my puts will expire, but my energy puts for sure will. My accidental puts are going to expire in the next month and two. My Permian Resources puts are going to expire. My Kinder Morgan puts are going to expire probably. And that frees up a lot of cash. So over the next few months into the autumn, I think the market is pretty weak. If the traders and the narrative makers and the chest thumpers and the tweeterers can keep this market fighting the Fed effectively, all that means is that liquidity was high and they were able to pull it off. At some point, financial conditions essentially mean there will be a deeper correction. Again, I don't know if that just means 3,500 or 3,000 or 2,500 or 2,000, but understand this. We are under an economic attack from OPEC, Russia, and China. China tries to maintain some plausible deniability. They're more clever than Russia. And Saudi Arabia just doesn't care. They've basically said, we're in it for the money. You do you. And I think part of you do you was the Inflation Retirement Act, which some congressional Republicans are taking aim at. I don't know why. It's maybe one of the best bills ever passed. It is going to aid us in this energy transition and try to mitigate the pain of the process. And from that, they're also pointing straight at the winners because they're giving those winners money. So you can complain about the government picking winners, fine, but you should at least, buy some of the winners. And those alternative energy stocks, for now, Occidental and Permian Resources until they peak out, until there's a big FOMO rally, then you can sell them. And any dip in Occidental, we've talked about it for months, sell puts, sell those $60 puts over and over and over again. I have 2 tranches of those that are going to expire. So I've got, I'm going to go watch the Brewers opening day here in a minute, but I'm going to put all these charts into a chart book for margin of safety that are already up at fundamental trends. I'm going to add some more of my charts, not this one, but this was a good example. Everybody that's breathy about, my small cap stocks are down, Well, look at this. This stock was down 95%. And it's back to go. Just telling you, this is the nature of things. And in an era where there's twice as many traders as there was 5 years ago, it's going to be more volatile. And that's good for you. Volatility is good. It allows you to take a breath and look for those spots to buy. Now, what's the definition of a stock that's down 90%? I believe it's a stock that was down 80% and then it dropped in half again, right? From 100 to 20 to 10. It happens. Stocks go from 100 to 50 all time. Then they go from 50 to 20. Sometimes they go from 20 to 10. Or from 10 to 5 to 2 to 1. If you buy in slow at wide price points, say here and here and here, look at that. This one's not super profitable, but this one is. So is this one. Do not expect the Fed to fire their bazooka until they absolutely have to. They let SVB go to 0. They let Signature go to 0. The next bank that it happens to, you know what's going to happen? Do you know what the price is going to be? Actually not 0. It's going to be 2. Because JP Morgan and Jamie Dimon, they buy things for $2. First Republic, which I've been selling some puts on, I'm starting to lose faith in their management. They should absolutely be selling themselves and diluting by 80 or 90%. But out of that would come a very strong bank. And it would probably become a national. But management is taking care of who? Management. If you need something to sell, I'll say it again. If you scaled in slowly and at wide price points, as I told you to, and I repeat, ad infinitum or ad nauseum, find a tranche that you're about even on and sell it. If you have an overallocation. If you have companies that aren't on our plug and play list, very good, and not all of them, but very good candidates to be sold in most cases. If you have S&P 500 stocks that used to do good and they're not doing so good now, sell them. The S&P 500 is in general not really where you want to be. Out of every recession, the small caps lead. It won't be any different this time. You need to become more comfortable with small cap investing. That's where the money is. And then the dividend payers, there's a select number of dividend payers up and down the capitalization scale that makes sense. But a lot of them don't. Anywhere that they can get their dividend cut, you should really avoid. Anything on my list, they're pretty much done with their dividend cuts, or they're never going to get one again. People say, well, AT&T and Intel and Kinder Morgan all cut their dividends. Yeah, and they're much, much, much healthier for it. It's fine to own these stocks after they cut their dividend or when the market starts pricing it in. Well, they priced it in on Intel a year ahead of time. Then it happened. What's happened to Intel since the dividend cut? Stock went up. Think about the businesses like businesses, right? Think about your stocks not like gambling tickets, not like something that trades up and down. Like you should be thinking about what's going to happen next week. No. Think about the businesses. Anything that you invest in, if you haven't gone to their investor relations page and spent the night at least looking at all their PDFs, shame on you. You're not allowed to buy stocks if you don't go to their investor relations page and read the presentations. There. Rule number 1. You must go to the investor relations page and read the last few presentations and spend a night or 2 or 3 learning the company. And then you follow them and you read the news. You go, oh, that makes sense to me now. You can't invest in stocks if you don't do some work, period. Doesn't matter how many guys like me you listen to. You have to get familiar with it, because the only way to understand something is to put in some study time, period. I can explain to you what things mean. I can tell you where the margin of safety is. I can tell you where the upside is. But until you choose to learn about the companies you're invested in, you'll never feel comfortable and you'll make mistakes. You have to be patient. Learning gives you patience, because the stock that dropped 95%, there you go. It's just a cycle. It was just a series of events. Now, on tip ranks, I look dumb because they only go out 1 or 2 years. This took 4. Oh well. But for people who did end up buying some of the stock down here, at least this tranche is up 20, 25 fold for you. All right. I will update some charts. I get out the quarterly game plan tomorrow. That's my editing day. I get it all edited up, and away we go. All right. Take care. Happy baseball season.